The stock market opened up this morning after a big drop yesterday. The Dow lost more than 300 points at closing and officially entered a bear market.
So we want to bring in Akiko Fujita to explain a little bit more what this all means. She's an anchor and reporter for Yahoo Finance. So Akiko, we hear bull market, bear market all the time. So we're going to start with the basics here. What exactly is a bear market?
Yeah, so bear market territory in the simplest terms is 20% decline from its most recent highs. That's exactly what we saw yesterday. 5 straight days of declines. While we're seeing a bit of a healthy bounce back today, Dow up more than 300 points. The reason for concern in entering the bear market is because of the historical context. 2 numbers to point out here. Since 1929, there have been 26 bear markets. 15 have been accompanied by a recession, and that's what's raised fears at a time when there's already concern that the U.S. economy is headed towards a recession. In terms of how long this could last, one average bear market lasts about 10 months or so. So that's something that investors are keeping a watch on.
So, Akiko, what's driving this sell-off?
Yeah, there's a number of things right now. Obviously, those recession jitters are front and center right now. But when you think about what's happening globally, we've been so focused on the Fed. So let's start with there, because central banks around the world are raising rates at a very rapid rate. Here in the U.S., the central bank has had 3 supersized rates, 75 basis point hikes, 3 consecutive meetings. You look at what's happening over in Europe. The European Central Bank just raised their rates by 75 basis points as well. Expectation is they'll do the same next month. And then you've got what's happening over at the Bank of England. They came in a little lower than most people expected with a 50 basis point hike. But when you look at what's been playing out with the pound weakening at a rapid clip, there is a concern here that they could go really aggressively. Bottom line, when you look at the global central banks, the concern is that they are raising rates too aggressively too soon, because oftentimes there's a bit of a lag factor here. It takes a while for some of these central bank moves to take hold. We heard from Chicago Fed President Charles Evans today expressing that very concern, saying that he is worried things could move too quickly when we haven't necessarily seen the impact from the initial rate hikes take hold just yet.
Which is sort of concerning, because we've already heard from the Fed that we should expect another rate hike before the end of the year. And I was thinking the same thing. I was thinking, well, we don't even have time to figure out if this last rate hike actually is going to work or not. And so as we sort of keep hiking and the stock market keeps tumbling, I mean, how concerned are experts that we are looking down the barrel of a recession?
Yeah, increasingly it's becoming that way. And we have heard Fed officials, including Jay Powell, saying there is some pain that will have to come along with us. At the core of all of this are record inflation rates. You look at where we are in the U.S., the headline number at just above 8%. Looking at globally, inflation at a very high rate too. So central banks are kind of in a bind right now. On the one hand, having to move aggressively so they don't see runaway inflation, they can get that under control, but also being mindful of the impact there. In the U.S., we've heard the White House officials say repeatedly that because the labor market is so strong, they don't believe things are headed towards a recession. But at the same time, you've got the Fed saying we have to tick up unemployment to a certain level to curb inflation. So we are really looking at sort of this catch-22 situation when you look at central banks.
Akiko, before you go, let me ask you quickly, where are you seeing money flowing to now? In other words, and distinguish between institutional flows and assets and retail assets. Generally, it's my impression that when we see volatility like this, retail money tends to go running for the hills, whereas institutional money looks at the fundamentals and perhaps might even find some opportunities in this in these market gyrations.
Yeah, I mean, we're increasingly hearing of people putting cash on the sidelines because they're worried about any returns coming from the markets. But you're right. There is a distinction between retail and institutional money. In terms of retail, I've been quite surprised by the conversations I've had with a lot of these platforms, these trading platforms, where a lot of retail investors tend to go to, who say they're not necessarily seeing people pull money out of the market, but they are being a little more discriminatory, putting them in something like ETFs, for example, funds, not necessarily individual stocks, that give them a little more diversification. We've heard on the institutional side increasingly people saying, that whole notion of not necessarily getting the big returns in bond yields, that's not necessarily holding right now. So we could see some money move in that direction as well. But cash increasingly something that we are hearing right now, especially given the declines we've seen most recently.
Really interesting. Akiko Fujita, thank you very much. As always, we appreciate it.